Brilliant. Thank you so much, everyone. Good morning, good afternoon, wherever you are in the world. We welcome you to our webinar on navigating UK sustainability reporting. And today, for the next hour or so, we're hoping to present a deep dive into transition planning. My name is Helena Walsh. I am one of Agendi's managing partners. I'm joined by my fabulous colleague here, Yin Mui, and also Fabrizio Palmucchi from Impactivise. Brilliant. Before we begin, and I should say apologies, we're planning to share around 45 minutes of content. We'll be more than happy to share the recording, all of the webinar slides with you after the session. The Q&A should be enabled, so if you have any questions, feel free, jump in. We'd love to reserve some time at the end to answer those. Otherwise, we'll get to those offline. A very quick flash to Agendi before we begin. We are a specialist climate sustainability consulting firm. We support organisations of all sizes, all sectors, with a focus on large global listed organisations on all things sustainability. We support from all the way from the quantification, the setting of strategy, how to meet that strategy, and wrapping that up all in reporting and disclosure. Particularly important, those last three categories, because that's the focus of our discussion today. Setting a target, defining that strategy, disclosing on that transition plan in order to meet those targets in place. I'm very pleased to be joined by Fabrizio. Perhaps, Fabrizio, you can introduce yourself and Impactivise, and then we'll get stuck into the content.
Well, thank you, Elena, and thank you everyone for joining in. So at Impactivise, we're a boutique consultancy. We align capital with climate goals. So we're going to talk a lot about transition planning. That transition plan will need to be funded, and that's where we come in. So my own background is investment management and rating agencies, and I founded Impactivise in 2022. We've advised about 20 clients and involved into capital flows of about north of 4 billion. And very importantly, not only we work with corporates, but with investors too. If we can move to the next page, please. So with corporates, we primarily work with CFOs and their teams, but as well as CSOs. Of course, transition plans are in most instances driven by CSOs, and they are a really good tool for engaging with investors. And we're going to talk about that a little bit later. But overall, what we help companies with is to reduce their cost of capital, reduce the business risk, and avoid greenwashing. Thank you, Elena.
Brilliant. I think we momentarily lost our slide deck again, Yin Mui. Is that right? Oh, no, apologies, it is here. Right, moving along, we've got a few technical difficulties today, but hopefully that will be the very last of them. For those who are joining, this has been part of our three-part series focusing on UK disclosures. Our first part, we provided a comprehensive guide to all of the mandatory and expected mandatory disclosures within the UK. In our second part, we deep dived into the climate-related financial disclosures, otherwise known as TCFD in its former form. So feel free to reach out to us if you would like any of those webinar recordings. Fabulous. So focusing on today and hoping to get stuck straight into the content, our goal is to, within this webinar today, is to deliver practical strategies for navigating the complexities of corporate climate transition planning. We'll do a quick flash overview of the transition planning consideration. Why do we have one? What frameworks are available? What's happening in the UK? Spoiler there, it will be mandatory at some point. And then the plan is to step through the key steps on how to develop and implement your transition plan. So we'll run through maturity mapping, ambition assessment, a risk and opportunity resiliency analysis, developing the plan itself, and then implementing the plan. That's where Fabrizio is going to jump in when we start to look at financing that plan, and then wrapping that up in terms of drafting the plan itself. And then, as I said, we'll leave time for key takeaways. Lovely. When we talk about transition, essentially we are looking at meeting our global climate goals. But as we go along the way, what we need to understand is that we need to avoid all of the harsh climate-related impacts associated with a high emissions future. We're talking about food insecurity, severe weather events, any of the acute chronic weather events, potential increased health concerns. So we know we need to curb our global emissions to avoid that high risk physical risk scenario. But when we look towards achieving this more optimistic future, of course, it comes with its own risks in terms of the need for potentially disruptive, widespread changes to the way we operate, our behaviors, and of course, financing that route as well. So the concept of how to make this fair, how to bring forward solutions and meet those plans will be scattered throughout this webinar. So transition plans, as I said, are expected to become mandatory within the UK. There's already forms of transition planning mandated within Europe under the CSRD. And for many of the organizations who have hopefully just submitted their CDP response, in order to attain an A-list position via the CDP, you do have to have a public transition plan in place. So some of the key drivers and benefits to having a transition plan is, of course, getting ahead of regulatory compliance. So the Transition Plan Task Force we will focus on shortly, addressing stakeholder expectations, being able to disclose what your long-term goals are, how you're going to get there, and how you're going to support that route. Of course, facilitating strategic planning, risk management, where that sits in relation to your existing climate-related financial disclosures. Of course, there's a voluntary component of it, ISSB being voluntary for UK companies for the moment, but any of those planning to future-proof and prepare would certainly be already stepping towards understanding what those requirements may mean for your organization. And of course, being able to align your long-term climate ambitions will support brand alignment and protect reputation down the line. Lovely. And so we're recognizing here we have a widespread number of organizations at varying stages across their route to implementing a transition plan. We may have some organizations who their organization is not yet aligned with our global climate goals. We may have participants who maybe have some commitments, but they're yet to have that robust plan in place. We know that many organizations may have long-term ambitions to align with our global climate goals, or maybe in the process of aligning. Maybe they're starting to look at science-based targets. And then all the way at the end, we might have organizations who potentially have that long-term ambition. They have the targets, but potentially need to look at what that looks like in terms of implementation, stakeholder engagement, financing, the role of technology, and so forth. So we hope to touch along all of these points along the way, but do reach out if you do have any follow-up questions or you'd like to hear more in a particular area.
Right. Now, diving right into it, let's start off with the basics. Understanding what a climate transition plan is, we can understand it as being an aspect of a company's overall long-term climate strategy that includes the short, medium, long-term targets, actions, and accountability mechanisms in order to align the company's business activities with a net zero emission pathway, thereby delivering real economy emission reductions with the objective of limiting global warming to 1.5 degrees. In assessing the credibility of transition plans, the Transition Plan Task Force, or TPT framework, as mentioned by Helena, is the current leading standard and provides common language and structure for disclosure. You will also note that the reference to Transition Plan Task Force will be used throughout the webinar today. We have listed here a few essential criteria of what a credible transition plan is expected to have, keeping in mind that this list is by no means exhaustive. So first of all, we have alignment with international decarbonization goals, ensuring that plans are ambitious and reflect the urgency to act in line with latest scientific findings, so meeting net zero by 2050. Secondly, we want to ensure that plans are strategically integrated within existing mainstream filings in your financial reporting, your sustainability reporting, and ultimately in your overall business strategy. And lastly, we want to make sure plans have verifiable and quantifiable key performance indicators so that companies can track and measure the success of your plans. Moving on to the next slide, when designing transition plans, what we want to ensure is that they are guided by key principles and also include clear information on the ambition, the implementation plans, and accountability mechanisms. On the bottom right, we want to make sure that plans are built on the 4 pillars of climate-related financial disclosures. So we have governance, strategy, risk management, and metrics and targets. Also, we want to ensure that they are guided by principles of accountability, so ensuring that plans have clearly defined roles and responsibilities. Plans should also be internally coherent, so integrated into overall strategy of the organization. A good plan is forward-looking, so focus on near and long term, keeping in mind that a focus on the near term is critical to achieving long-term goals. A good plan as well is time-bound and quantitative, so ensuring that KPIs are quantifiable. And lastly, ensuring that plans are complete and regularly reviewed, ensuring that there are no material exclusions and cover the entire organization. On this slide, we have laid out the frameworks, guidance, and transition plan initiatives, which companies can reference as they start to develop their transition plans to better prepare for future mandatory disclosures. In terms of regulations, currently the CSRD captures UK companies with material EU operations. And under the CSRD, there are requirements for companies to disclose transition plans if they have one. For future expectations, the UK is expected to endorse the ISSB under what's known as the UK SDR, so Sustainability Disclosure Requirements, to have transition plans in line with the Transition Plan Task Force. Additionally, the EU CSDDD will also require companies to develop transition plans aligned with Paris Agreement goals. If we look at even more in the future, we can expect as well additional potential developments looking at the rollout of these requirements to an expanded scope of companies, as well as possible assurance expectations to come in force. What we have on the left is a list of a non-exhaustive list of frameworks, guidances, and initiatives that companies can look for as they better prepare and develop their transition plans for future mandatory disclosure. So I won't go through the entire list, but what we have is the Transition Plan Task Force. As mentioned, it's considered the gold standard in transition planning, and it provides a disclosure framework, implementation guidances, as well as additional useful resources that companies can look to as they develop their plans. The CDP has also published a technical note on climate transition plans and offers detailed guidances on the development and implementation strategies. Climate Action 100 Plus, or CA 100 Plus, is an investor-led initiative, and companies can also use the CA 100 Plus to align expectations of their plans with investor demands. It also provides a useful benchmarking, which assesses the performance of focused companies against the initiative's goals. A couple additional ones include the ACT, Transform to Net Zero initiative, as well as Transition Pathway initiative, all of which also provide useful materials and resources that companies can reference in their development of the plan. One to mention is the ATP Collective, so the Assessing Transition Plans Collective, who have just recently released a guidance that provides a credibility assessment process for transition plans. It shares best practices and lessons learned from successful transitions and includes granularity credibility checks to better understand how third-party assessors may analyze the transition plans.
Brilliant. So as we said earlier, within the UK, it is expected that transition plans will become mandatory. Of course, this is pending the Q1 2025 endorsement of the ISSB. And then what's going to roll out after that is there's going to be a consultation to strengthen the transition plan disclosure, and then following that along with the TPT framework. Of course, this didn't come out of nowhere. The TPT framework itself was established in 2022 following COP26. COP26 in 2021. And then, of course, it's all part of the green finance strategy within the UK. And then in terms of a deep dive of the Transition Plan Task Force itself, as I said, it was launched in 2022 by the HM Treasury. Essentially, it's another disclosure framework. And on the next slide, I'll run through the key disclosure elements. There was a large spread consultation, which of course understood how that will look like in terms of the guidance and the detailed application for organizations. So there's some really wonderful knowledge resources within the hub. What we also have is some really fabulous mapping documents to understand what that looks like in terms of other potential frameworks that your organization may come under. And then in terms of the framework disclosures itself, we have 3 key principles, which of course is the ambition of the plan itself, the action, and how to make that accountable. And then we have those 5 key disclosure elements of the foundations, the implementation strategy, the engagement strategy, the metrics and targets, and the governance. And sitting under those 5 key themes, we of course have 19 sub-elements of disclosures. Now, how this is transcribed within mandatory UK reporting, we're still expected to see that roll out. But some of the key pieces of information that Yin Mui was talking about, which is also having this long-term strategic ambition and what your products and services, your financial planning, your operations, how you can build that up, understand all of those mitigation levers to essentially achieve that longer term ambition. Now, engagement strategy is very, very important with this because, of course, it needs to take place across your value chain to understand what are the implications of this strategy. Can your value chain support that particular plan? What are the implications to make sure that it's fair and just? And of course, if we think about the metrics and tracking, what we need to be able to do is track the rollout of that plan and have the governance to support it as well. So we'll be stepping through this as we go through the roadmap. And we'll hope to deep dive in each of these key areas. So as I have up here, we have a very, very simplified transition plan process. We've got it divided up over 5 key stages, which first is maturity mapping, ambition assessment to understand where you are, where you need to get to, what kind of regulations you need to tick off along the way and embed into your strategy, how that relates to the risk and opportunity resilience analysis. And then we have developing the plan, making sure that there's targets in place, there's a decarbonisation pathway, all of those transition levers are fully explored, and the role of technology is integrated. And then as we come on to implementing the transition plan, that's where we'll hand back to Fabrizio, who will run through the financing, governance and accountability, and how you can go through and implement dedicated stakeholder engagement. I say dedicated stakeholder engagement there because we expect to see continual stakeholder engagement throughout both the development of the plan, as well as the ongoing monitoring and tracking of your transition plan. Brilliant. I'll hand back here to Yin Mui, who will step through these first key phases.
All right, thank you. The first step of transition planning, as mentioned, is to assess and understand where you are in terms of your current status and also setting the strategic ambition of your plan, both of which are crucial to guiding the direction of the steps that are to follow. We recommend companies to start by conducting a gap analysis and maturity mapping of your current disclosures in order to pinpoint priority areas and identify required supporting activities. Gap analysis is also important to inform the requirements for data collection and stakeholder engagement. Companies can also benchmark their position against peers and leaders within the industry to better understand their positioning and the level of disclosure expected. This helps prepare them for the right type of information to be included, as transition plans can range from being high level to comprehensive. On this next slide, one thing to note is that it is important to understand that all companies, regardless of climate maturity, can and should start their transition plan journey. Here, we've broken down the key transition plan elements, referencing leading frameworks, and laid out how disclosures may look like for companies which are either in early stages of preparation versus those more advanced in their disclosure journey. So if we look at companies in early stages of disclosure, we expect to see key elements of their implementation roadmap, risk management, climate governance to be present. There may be few or none sustainability-linked metrics beyond just greenhouse gas emissions quantification, and disclosures may take the form of a high-level draft. For companies that are in the strategic integration stage, these organizations start to incorporate sustainability and climate goals into their wider business strategy and decision-making. They are likely to have a 1.5-degree aligned climate target, including a net zero target, and also have additional considerations of climate-related KPIs. Robust climate governance processes and procedures should be in place, and they may consider additional incentives linked to climate accountability and oversight. Moving on to the future-proofing group, so these are companies who are really looking proactively to prepare for future regulatory changes, such as the UK SDR. So for these companies, we're looking to have a 1.5-degree aligned net zero target that supports the acceleration to a lower carbon economy. They should also consider more innovative decarbonization efforts, having low carbon service offerings, and also aligning their financial planning with transition plans. And lastly, for these companies, they should also look to assess the credibility of their plans. So for example, referencing the leading frameworks and standards, as well as initiatives as outlined in the previous slides. In all instances, companies should look to consider and disclose all key assumptions and dependencies made for their transition plans. When it comes to setting your strategic ambition, what you want to think about is your strategic vision for the role you play in the transition to this low emissions, climate resilient economy, and also what objectives and priorities need to be defined to enable it. When defining your objectives and priorities, some key considerations you can think about are how you plan to decarbonize the entity, how you address and respond to the climate-related risks and opportunities your organization is exposed to, and ultimately, how in setting your strategic ambition, you plan to contribute to an economy-wide transition. These factors are, of course, unique to and dependent on your industry or sector, the operational context, so your geographical location, the regulatory environment you're in, as well as the transition levers available to your organization. Ongoing stakeholder engagement, as mentioned by Helena, can also help inform your objectives and priorities. What you will also want to be clear about is challenging any underlying assumptions made about your capabilities and the external factors that could affect your plan. This will allow you to better assess the robustness and feasibility of the plan. It will also allow you to better articulate clearly where you do rely on external factors, and also inform your subsequent implementation and engagement strategies. When setting your ambition, keep in mind that a good transition plan should be ambitious and reflect the urgency to act. The next step we'll look at is looking at your risks and opportunities disclosure. So Agendi's part 2 of the disclosure webinar series actually does a deep dive into climate-related financial disclosures. So for those of you who missed out, please feel free to reach out directly to Agendi to assess the materials or recording. So the first thing to note is that transition plans should build on existing climate-related risks and opportunity assessment, which are disclosed in line with climate-related financial disclosure recommendations, building on ISSB. Mapping your progress to date can help inform any next steps as part of your analyses. This can include carrying out any climate scenario analyses to better understand your company's exposure to risks, and also what associated management strategies may be needed. Companies can also take into account further considerations, such as nature-related risks and opportunities, and also recognize what impacts and dependencies, either within your own operations or value chain, that it can have on stakeholders, on society, economy, and the natural environment. By doing so, this will allow you to look at the actions that can be taken to minimize risks and capture opportunities. It will allow you to identify where collaboration, engagement, and co-financing with others may be needed in order to manage the risks. and also identify any potential trade-offs and synergies, and ultimately develop an action-oriented plan. And the aim of this is to facilitate the development of a plan that increases your long-term value. Going on to the next step, which is the development of the transition plan, a couple of key elements are important to highlight here as you develop your plan, including your target setting, your decarbonization pathways, the transition levers that are available to you and your business, as well as how you can leverage technology to help implement the plan. Setting robust targets, starting off with that, is important to guide your transition plan towards your strategic climate goals. And companies should evaluate existing climate metrics and targets to ensure that they align with your plan and effectively measure progress. In setting targets, you will want to consider those which cover your business activities that are related to your strategic ambition, and use a combination of internal and external targets. This can include greenhouse gas emission targets covering your material scopes. It can also include climate resilience targets, business and operational targets, or targets that cover your governance, engagement, or financial targets as well. In all instances, companies should take care to ensure that the target and accompanying metrics and KPIs are clear, measurable, and also time-bound. When possible, it is also best practice to adopt common metrics that enable comparability. For each target, it is best practice to disclose any milestones or interim targets that can be used to measure progress. And when formulating targets, both near as well as long-term goals should be aligned with a 1.5-degree pathway. You should consider as well linking individual targets to action-oriented implementation steps, as well as your engagement plans, and linking it to your overarching objective and priorities and strategic ambition of your plan. Targets may need to be refined and iterated over time, either due to evolving regulatory landscape, advancements in technology, or changes in your internal capacity and resources. So to keep in line with best practices, companies can choose to attain external target validation to enhance robustness. So on the right, we've listed down some key target setting frameworks, such as the SBTI, the ISO standards, the Climate Pledge, and Net Zero Initiative. Companies should also think about what strategic levers that you have available to contribute to this transition. Transition levers can be thought of as consisting as two key components. The mitigation actions over the short, medium, long term. These are actions that the company undertakes or plans to take to mitigate the impacts of climate change. These can be technological, such as having energy efficiency measures, renewable energy, or product substitution to lower intensive options. They can also be non-technological, such as having training or engagement initiatives in place. The second part is having considerations and decisions to factor in order to support the feasibility of these mitigation actions. Companies need to factor in the external dependencies, for example, the availability of your technology and infrastructure, any constraints in your geographical location, the human and labor resources, or consumer and client behavior, as well as any financial resources and considerations on how these mitigation actions will be funded. You should also look to disclose the assumptions and calculations that back up each of these transition levers where information is available, and look to challenge internal capabilities where possible. One thing to note is that transition plans should not be restricted to only decarbonization. Companies should use the specific levers and capabilities available in order to accelerate the transition to a low carbon economy. What this means is that companies should take a broader strategic perspective on climate change and include considerations of opportunities for new, improved, or restructured products and services. It also entails working with the value chain to ensure the effective adoption of these services. Some of the questions you may want to think about as you dive deeper into creating your roadmap are, What are the key changes required in your business operations, in your products and services? And what are the implications on your business model and value chain? How can changes in the short, medium, and long term help you meet your strategic ambition? Based on your identified levers, you may want to map these into granular action-oriented steps in the short, medium, and long term. To allow you to create a portfolio of actions to inform your plan, you can consider a number of processes, including any process changes, so changes in your operations, in your supply chain, in your workforce, perhaps. So for example, having energy efficiency measures or switching to less carbon-intensive processes. You may want to also consider changes in physical assets and facilities, so relocating to more climate-resilient areas or buildings. In terms of your products and services, companies may want to phase out high-emitting or climate-vulnerable products and services and increase your share of low-carbon market offerings. And lastly, consider as well what adaptation strategies can be taken into account for climate resilience. In curating a plan, you can also see from some of these headline screenshots that technology plays a crucial role as being an enabler to the sustainable transition to a low carbon economy. So by investing in climate tech and leveraging transition finance, businesses can accelerate your journey to net zero. So I will pass this on now to Fabrizio, who will dive a bit deeper into climate finance and how companies can leverage this in developing their transition plans.
Super. Thank you very much. Well, it's really great to be here. As you can see, can we move the, yeah, super. As you can see, it's a very big piece of work, transition planning. I've been involved in some of those CSRD in Europe, transition plans, and it is definitely a significant piece of work. And here, I will take the perspective of the investor and how you can really leverage that piece of work into an opportunity, because there's an opportunity to raise capital. And if we move one further, just one more. Yes, so that's the agenda that I have for you today. So we'll talk about this financing opportunity and the sustainable finance market. Then we'll go into actually a practical example of engaging with investors on the transition plan, either before you publish the plan, perhaps because you want to know how you should frame it, how you should really work, what are the important elements the investor will look at, depending on the business, or actually after. And then the third part would be the lessons learned on those experiences. If we move one, yes. So the chart is going up. That's great. That's exactly what it is. Sustainable finance market is growing. It's becoming a big part of the market. On the left-hand side, what you see is sustainable bonds, green bonds, sustainability bonds, social bonds, etc. This is data coming from Reuters. Those bonds represent today approximately 15% of global bond issuance. So it's an area any company can't really ignore. Because it's relatively big. On the right-hand side, you see how those bonds are used in mutual funds. And this is data on the right-hand side from Morningstar. You can see that climate-focused funds, AUM, is growing as well. And again, that's an opportunity for corporates who wants to tap into a new type of investor. And this is what we are talking about here. When we talk about transition plans are quite specific, and sustainability investors are really looking forward to those and are the ones really to talk to leverage that finance opportunity. So if we move to the next slide, I'll show you a idealized. This is not a real one. This is coming from the Climate Bonds Initiative. What investor actually would love to see, okay? So again, this is hypothetical, but this exemplifies what Elena and Yin has been mentioning before. What you need to have is different targets for different dates, 2025, 2030, 2040, and 2045. Of course, what really matters from an investor perspective is 2030, because we have visibility in terms of what can be done by 2030. And for each target, you want to see, investors want to see the levers and how you're going to finance it, which is the purpose of the slides of my part here. And here you can see for 2025, this hypothetical plan shows a sustainability linked bond, a green bond, and for target 2 in 2030, a sustainability linked bond. Again, this is hypothetical, but now I wanted to show you a transition plan which has been published last week, in fact, on Thursday, by a company in Europe. If we move next. So here, first part of the transition plan is a 30-page document, which is public. This is from SNAM. It's a gas transmission company in Europe, with mainly in Italy. So they obviously give themselves targets for scope 1, for scope 2, and even scope 3 upstream that you can see here. Now, that's all good. How are you going to finance it? How is the company financing it, which is the question of the investor. So if we move to the next slide, you can see that the company is expected to have a significant capex plan of 11.5 billion over 4, in this case, up to 2027. And that capex plan is obviously detailed per segment. Here, for example, H2 ready means hydrogen ready pipes that the company is going to install. And then you have a breakdown per alignment of the EU taxonomy and even the SDGs, which is, of course, extremely relevant for a sustainable bond investor. If we move to the next, so this is an example of a plan which has already been published and which really details how the company is going to execute the plan and is going to finance it. One thing I didn't mention is that how the company is going to find these 11 billion. The company's target is actually to use the sustainable finance market for 85% of the financing. So that's a very important part, because this is why the investor is being engaged. The investor needs a tool to execute on the plan, and the tool could be a bond, it could be equity, it could be something else. So again, how do you engage with investors to really leverage that plan? I've been through some examples, and I'll share with you my own experience. If we move to the next slide. So first, the why. Well, you want to clarify your transition journey. Well, one thing to remember is that the investors themselves have net zero targets. So your journey is going to be the investor's journey. So how do you align with that? 2, you want to engage with a new pool of investors. This is what I was mentioning before. And 3, potentially you want to convert those investors. The more you engage, the more you disclose, the more you communicate on your business, the higher the likelihood that the investor is gonna take it on and invest. If we move to the next slide, please. Yeah. So let's say you decide to go, you want to go and engage with, as the TPT mentioned, towards stakeholders. Here I'm focusing on investors. You need to set your objectives, right? So of course, primarily it's about the transition plan, but every company has, there is a sustainability challenge for every company. If you think about even renewables, renewable energy, think about solar. If you're a solar company or like a pure play electricity generation company through renewables, through solar, for example, well, one key question is how are you going to decarbonize your scope 3 upstream emissions? So basically, the emissions from building the panels. So there is, for any company, there are some key points to go through. It could be those scope 3 emissions, could be the capex plans. It could be that actually you have some plans to finance this through bonds, or maybe you have a questions about ESG ratings you're using. Are the investors really using it? Is it helpful or not? So that's on the formal side. On the informal side, as I mentioned before, the more you convey, the more you increase that dialogue with investor, actually the higher the likelihood that the investor actually will buy and will want to buy and will want to invest one way or another into the company. If we move to the next slide, please. So if you want to do that type of exercise, again, you could do it before you publish the plan to make yourself as well more comfortable with what you're going to publish. So that's one case, one use case, or after, just to discuss your plan. Well, the way I would advise, or the steps would be the following. First, you want to start with a very small pool of investors at the beginning, 3 to 4, and you want to select them strategically. You want to prepare some materials, some questions that you have, as I mentioned before. And what I would do is really, because you want to really leverage those meetings, having meetings with those investors is actually quite high value add time. So what I would do pre-call briefings with the investor and with yourself as the company before to prepare, and then we have the meeting. And after the meeting, you will have for sure action points or follow-ups, because you will know things that you didn't know before, and these are very, very important action point to really fine-tune, as was mentioned before, your transition plan. If we move one, and then so what are the lessons learned? So you can see the picture. Why I have this picture is simply because it's a win-win. It's a really win-win because as a company, you know inside out your business. The investor may know your sector, but doesn't know your business as well. And the transition plan is another way to talk about your business. And investors generally appreciate that. The other thing is that investors are more understanding. If you think about the TPT and or CSRD, ESRS in Europe, the points are quite prescriptive. There's lots of rules but actually when you go and you have a dialogue with investors understand that the 1.5 degree alignment is really hard. And what they want to know is why it's hard and what are you going to do about it? So that's the discussion. And generally the discussion is actually very fruitful. Governance, I didn't really talk too much about governance, really, really important because the investor want to know that transition, that piece of paper that is there or that PDF is actually going to be executed. So who's going to be responsible for it? Hopefully the board, and how is it going to be accountable is something that is often very well discussed. And then the last lesson learned I would say is that from doing that type of engagement is that you will have some follow-ups which are really unexpected. You didn't expect it because the investor is bringing a view which is a bit different. It could be perhaps there's an ask for a better disclosure from one of the scopes. There's plenty of nuances in there. It could be that they would like you to look at different types of KPIs. It could be that actually, if you're in a regulated business, that the investor wants to know more, or you need to disclose more about the role of the regulator. Or it could just be that the investor would like you to have more discussion with the regulator or to lobby more the regulator. There's a trillion of different ways that this can go, but at the end, it's all about engaging with the investor and fostering that dialogue in terms of how you're going to decarbonize your business. Last slide. So let me conclude. I can see there are some questions, so we'll have some time for those. 1, 2, and 3. The more strategic the plan, the higher is the value creation, not just for the company, because of course, when you decarbonize, you reduce your risk, your transition risk. But at the same time, you open up yourself to funding opportunity from investors. Again, I wouldn't highlight even more that investors are really keen to guide and feedback. So I think companies should take investors on that. And at the end, the opportunity obviously is more investment into the company. Yeah. With that, back to you.
Thank you, Fabrizio. So a lot of very valuable insights on also the importance of engaging with investors. So thank you so much, Fabrizio. So bringing us back onto the last step of our transition planning process, what we want to last look at is looking at how companies should approach their transition plan drafting, reporting, and disclosure. What we have here, we've listed down some key best practices. So first of all, and this has been reiterated throughout the webinar, is alignment with best practice frameworks. Alignment with the Transition Plan Task Force demonstrates your commitment to transparency and accountability. And this is increasingly valued by both investors and also other stakeholders. Secondly, companies should also look at integrated reporting. So publishing material information about your plan as part of general purpose financial reports, as well as making sure that they are updated regularly as well. As best practice, plans should also be published as a single standalone document that sits alongside these general purpose reports. The best practice is to review them at least every 3 years and have them updated if necessary or where there is significant structural change. Companies looking to future-proof their plans should assess their transition drafts against credibility frameworks. For example, the ATP collective framework mentioned and guidances can be used by preparers to better understand how assessors may analyze their transition plans in the future. And lastly, just monitoring and reporting on your progress. So including engagement with external stakeholders, including investors and also other stakeholders, as well as internally to assess how the information was received and also how it can inform future iterations of your plan. Companies should also bear in mind that reviewing and improving your data collection and monitoring processes should be built in within each iteration, so as to learn and reflect from the process to ensure continuous improvements. So with that, I will hand it to Helena to wrap up with some key takeaways, and hopefully we have some time for questions.
Brilliant. Thank you so much, Fabrizio and Yanyui. Wrapping up into terms of best practices and key takeaways, first and foremost, you can certainly apply a modular approach. The TPT framework allows for you to tackle those three dimensions of setting everything up within the foundations, actioning the plan, and then implementing it down the line. So, what you can do is break those down into smaller, more manageable components and build on that as you go. As Yinmui was saying, it's important to leverage existing processes in place. You can't fully externalize the transition plan. What's important is that you're understanding what's happening, where's the strategy going, what kind of documentation, metrics, targets, ambitions, where is everyone potentially going to be impacted by this plan? And all of that needs to be built on in order to implement into the plan. As we detailed, it's always important to look at a gap analysis and a readiness in terms of where you are, in terms of the data itself, the policies that you have in place to manage it, and the ability to disclose on that data, thinking about the data quality and any sensitivities. Obviously, when we start thinking about climate-related opportunities, you can potentially go very quickly into very sensitive strategic areas of a business. So how can you balance that need for disclosure to bring forward the investor confidence, but also maintain the appropriate commercial sensitivity? We also have accountability and cross-company input. This certainly does not sit within a sustainability team, which is part of the reason why we've got Fabrizio here. It's much bigger than just sustainability itself. When we think about some of the implications of an adjusted company strategy, there may be knock-on effects where we start looking at the need for training or the need to devise new roles within the company for certain areas of the business that may be transitioned or phased out. So making sure that that doesn't just sit within the responsibility of one team, but it's owned across the business is certainly important. And then when we come down to accountability, these plans are, for the large part, going to extend past the tenure of most of those who are setting it in the first place. So understanding how can you tie back that long-term actions, goals, strategic goalposts down to shorter-term interim targets, as Fabrizio was running through as well. Looking at the TPT framework, certainly that will allow you to build, enhance those disclosures all the time, or identify a gap where you can start tracking data, where you can start building an engagement strategy to make sure that that plan is continually being adjusted. Of course, the targets themselves are super important for a transition plan, whether it's a long-term aligned 1.5-degree plan. What we want to try and do is track back and tie those targets to some of our leading frameworks, ideally science-based target framework, but there's many other frameworks that exist out there. It brings the credibility towards the longer term goals and also supports to create a framework for any changes down the line. And finally, continual engagement, understanding that some of these plans and some of the elements of the plans, it requires constant engagement, whether or not it's through the value chain, to make sure that your value chain can support both the delivery, but also the demand for the potential business strategy that you're creating as part of your transition plan, and looking at any of the affected stakeholders on the way. The role for making sure that the transition is rolled out in a just and fair way is certainly important as well. So I shall pause there. I thank everyone for your participation. We have a couple of minutes spare for questions, so I'll maybe take a quick browse. Miri, perhaps over to you. We've got a question here that says, does developing a transition plan without a net zero target make sense? What would it then focus around?
Yeah, thanks, Helena. Yeah, happy to provide some thoughts about that. Yes, I think absolutely it does make sense. A lot of companies are still early on in their transition plans journey. It is not mandated by any means that you have to have a net zero target in place. Of course, the best practice is to have a 1.5-degree aligned target. Companies should or can focus on more near-term targets in the next 5 years. It's especially crucial, actually. So focus on those and more on the decarbonization strategies. So if you remember one of the slides at the early stage, we split between the early stage disclosures versus a more advanced disclosures. So having some of those elements in place can at least position yourself to demonstrate that you are well positioned to transition towards net zero in the future. So I think definitely it does make sense to start as early as possible. Some action is better than no action, is what I like to say. Helena, I don't know if you have anything further to add.
That's brilliant. Fabrizio, we've got probably time for one more question. I think this one angled more to financing here. How should management of ESG risks be integrated within the annual report if you're trying to acquire financing from ESG-focused investors?
Thank you. Yeah. Well, I think ESG-focused investors, first of all, they will look at ratings. So you need to look at what I would do is first look at the ratings that are the most relevant for those types of investors. And there are many, many out there. Depends if you're a listed company, not listed company. So that's one thing. Second thing I would do is I would look at some of the ESG risk, let's say ESG assessment methodologies. They are all public from all the, let's say the rating agencies, being, the rating agencies, Moody's, Standard & Poor's, and Fitch, and let's say the other ones, and really try to tackle all of those in your annual report, definitely. Yeah, because the thing about ESG is that first of all, you can't tackle all ratings, or let's say all rating agencies, or all the raters The point I want to make is that there's probably lots of people looking at your reporting, but you don't know who they are, but they are making decisions without you knowing, because ESG is so broad and there's so many different players. So you really want to cover all your bases. Thank you.
Brilliant. Thank you so much. I think that brings us to time. Thank you everyone for your participation, for the great questions. Our email addresses are popped here if there's any other questions that you would like to direct to us individually, or potentially set up some time to discuss. But thank you very much for your time, and we'll be sharing the recording and the slides with you within the coming days.
Thank you.
Thank you.
Thanks all.